Cost accounting, critically important cost accounting terms. This is Ken Boyd with the Accounting Accidentally website, where you'll find over 400 blog posts and over 400 links to my YouTube videos on accounting. So this is part of a simulation question I wrote for a client. You are hired to assess the cost accounting system at a furniture manufacturing company. To discuss the results with management, you need to define these terms for the group. And I have what are 6 really important cost accounting terms, and so I'm going to discuss them on the next few slides. Variable costs change with the level of production. Labor and material costs increase as production increases because production requires more of these costs. So typically, you will see the terms direct labor and direct material to refer to costs that can be directly tied to production, and those are normally variable costs. Fixed costs, on the other hand, do not vary with changes in production. Insurance premiums and lease payments are typical fixed costs. So that's variable versus fixed. Now let's talk about direct versus indirect. Direct costs can be directly traced to production. I just mentioned 2 of them: direct labor, direct material. When you manufacture wood tables, for example, you can measure the amount of materials, the wood and the plastic you need to use, and the hours of labor required to make the tables. Indirect costs, also called overhead costs, cannot be directly traced to production. Instead, these costs are allocated based on a level of activity, and typically it's based on labor hours incurred or machine hours incurred. Those are the 2 big ways to allocate indirect costs. Repair and maintenance costs are overhead costs, and you might allocate these costs based on the number of machine hours used. If you use machine hours more often, you generate more repair and maintenance costs. Conversion costs include labor and overhead, and these are the costs incurred to convert material costs into a finished product. I'd say this is, if you're taking the CPA exam, this is probably the least tested of the terms in this presentation. Insurance expense is a conversion cost. Sunk costs are costs that have already been incurred. If an airplane is leaving in 15 minutes, most of the costs of the flight, the pilot and crew's salaries, the fuel, the lease to pay for the gate, food on the plane, have already been incurred. They are sunk costs. And I mentioned sunk costs because if you need to make a spending decision or a management decision, sunk costs are not part of your decision making because they've already been incurred, therefore they won't change. And I do want to make correction on the slide. Insurance expense, being an overhead cost, is a conversion cost. I just want to point that out because I went over that quickly. Last thing here, this is taken from Cost Accounting for Dummies Chapter 2, which is a chart that I made to explain that direct and indirect costs, fixed and variable, are connected. So for example, the salary of a factory guard at a production facility would be a fixed cost, salary is fixed, and a direct cost because it is directly tied to production. You wouldn't have the guard there if you weren't doing production. An equipment lease is a fixed cost, but it's an indirect cost because it can't be directly tied to production, fixed, indirect. A direct variable cost, as we discussed before, material and labor costs, the most common example. And then my 4th one, bottom right, a variable indirect cost. Now, this really depends on whether you have a fixed contract to pay for repair and maintenance, in which case it would be a fixed cost. But if you just paid an hourly rate for repairs, it would be a variable cost that is indirect. Remember that you can always join us in conference room, where we have blogs, videos, live chats, and other ways to help people in an accounting community. Thanks for watching, and we'll see you next time.